Uh, In reward for patience, I'm going to recognize the gentlelady, Ms. Jenkins.
Thank you, Mr. Chairman. I too have heard from a lot of financial institutions in my district on their concerns with mark-to-market standards, and I want to proceed quickly but responsibly. Both Chairman Frank and Mr. Sherman now have touched on this, but I'd like to follow up a bit on the issue of regulatory authority, and perhaps Mr. Bailey might have some additional insight. What I'd be curious to hear is, when assessing the regulatory capital of a financial institution, should bank regulators make adjustments to reverse write-downs that relate to the illiquid state of our markets today? And more broadly, what authority do bank regulators have to impart flexibility in regulatory capital requirements? And if the authority exists, to what extent has that authority been used?
That's a very good question, and I tried to address that important question in my written statement, but let me try to summarize the issues. Obviously, when we determine our capital adequacy regulations, we try to use GAAP as a starting point in that assessment process, in part because it does reflect a general market acceptance of how those assets and liabilities and equity should be reflected on bank balance sheets. We do, however, make our own determination as to how those inputs should be reflected in our capital adequacy framework. For example, goodwill, though, is completely recognized under GAAP, but that is not reflected in bank balance sheets because of the clear valuation issues associated with that. So we do have a large degree of flexibility, and we have exercised it. And again, as I indicated in my oral statement in the beginning, I think what we have tried to do in trying to balance the need for a risk-sensitive capital framework, which again is a critical focus of our attention, while at the same time trying to constrain volatility in resulting capital ratios. What we have done, and again, but for these trading portfolios, we have tried to neutralize the effect of temporary fluctuations in value from capital, but reflecting permanent changes in value in bank capital ratios. One other point, so we do have a significant degree of flexibility, and we have exercised it. But I do want to make one other cautionary point. And one of the things that we've looked to in this context is trying to make certain that bank financial statements, including bank capital ratios, have a degree of acceptance in the marketplace by both investors and the broader community. What we have seen some evidence recently that rating agencies and other users of financial statements are creating their own metrics to determine capital adequacy. And we believe what we want to do is make certain that our capital adequacy regulations do reflect the reality that is relevant both for banks as well as users of financial statements. In part because our capital role is the foundation of significant parts of our supervisory framework. And again, I think what we want to do is maintain the clear relevance of our capital ratios for a broad array of purposes, both supervisory and market related.
Thank you. If I might just follow up, I've also seen some proposals which I understand would separate out credit and non-credit losses. Non-credit losses would be recognized as other comprehensive income and not hit the regulatory capital. Would any of you like to share with the committee your thoughts on that proposal?
Well, I can start off. I think we have discussed that issue quite a bit, and I think that is appropriate because I think that is perhaps one of the most obvious issues that would warrant our attention. As it relates to the capital ratio, to the extent that you reflect in earnings and therefore capital, that the OTTI impairment that's related to credit, but the other impairment, the non-credit impairment that is generally associated with liquidity discounts in other comprehensive income, not earnings and therefore not capital, what that would do is further reduce the volatility of regulatory capital ratios. Because again, under that revised OTTI impairment process, what you're only reflecting as a change in capital is the credit-related impairment. And again, the more liquidity-based volatility is in OCI, other comprehensive income, and therefore not regulatory capital.
Okay.
I agree. I actually think it can provide additional transparency to investors by giving them both a perspective of the credit impairment as well as the impact on valuation of liquidity.
Okay, thank you. Thank you, Mr. Chair. I yield back.
Thank you very much, Ms. Jenkins. And